In this week's video, we'll review the latest charts and data to help us answer the question, are new all-time highs coming in stocks? It's the chart of SPY that we covered a week ago. It's dated January 10th. We said there were numerous reasons to be patient heading into CPI this week, including the fact that the S&P 500 had made a stand here in October of 2023, stand in a similar area in August of 2024, and we were back testing that same basic trend line during the session a week ago on Friday, January 10th. If we fast forward 5 trading sessions later to January 17th at 10 a.m. Eastern Time, you can see the stock market did make a stand near a logical area. We're back above the election gap down here that we've been talking about for quite some time. Not surprising that we came back and tested that gap. The chart on your screen is as of the close on Thursday, January 16th. You can see we came into the gap and it bounced, and during Friday's session we're trading in this area here, back above the 50-day moving average in blue, an upward sloping 50-day. This is the scoreboard early in the session on Friday with the VIX back comfortably below 20. The market's concern recently has been related to interest rates and indirectly related to inflation. As we've talked about in these videos numerous times, it is possible for stocks to do well on a longer-term basis in the context of a rising interest rate environment. During the secular trend here, 1950 to 1968, part of that window is 1946 out to the end of 1981. In that window, interest rates were rising. We had a secular bullish trend in interest rates, meaning that was not a good time to invest in bonds. And despite the rising interest rate environment, the S&P 500 from point A down here to point B at the end of 1981 gained 606%. So interest rates are absolutely positively relevant, especially in the short to intermediate term. And thankfully, rates, the 10-year yield, came right back up into this gap area here. This is the gap down here from November of 2023. And you can see when interest rates gap down here, the S&P 500 started a rally off of that October 2023 low. We came back up into that same gap here in April of 2024, and once again, the S&P 500 found its footing and rallied for several weeks. We came back to a similar area, overshot it, and during Thursday's session at the close, we were back below it. So you can make an argument that this point here is similar to this point here and similar to this region in here. The last 2 times that happened, good things happened in the S&P 500 for several weeks or several months. CPI and PPI this week both came in a little softer than expected. And if you've been watching these videos in recent weeks, we've covered in detail numerous charts that showed that the market didn't seem to be overly concerned about inflation. Of course, the market's concerned about inflation, but the charts didn't seem to be pointing to a risk-off setup similar to Q4 of 2021 and January of 2022. Here's another example of that concept. This is the shorter end of the yield curve. This is the 2-year U.S. Treasury yield. This is the portion of the yield curve that the Fed has the most control over, the shorter end of the curve. And you can see here, 2-year yields were rising already rapidly well before January of 2022. And you can see the 2-year yield has a full-bore bullish look in terms of the weekly cloud. Blue above red, yes. Green above price, yes. Price above red, yes. Price above the cloud, yes. And the cloud was green. It's not what we have over here as of the close on Thursday, January 16th. So once again, the right side of this chart over here really doesn't look anything like this alarming setup look in here that began across the cloud here, started to morph into something more concerning in this window here, again, well before January of 2022. This is what happened in the S&P 500. So the look of this chart aligns with what we've covered in recent weeks, and it also aligns with somewhat softer readings on the inflation front. Still believe that inflation's going to be around and a topic of conversation for quite some time. The same can be said for interest rates, but that doesn't necessarily mean inflation and or interest rates have to derail the secular bull thesis. Stocks can do extraordinarily well in the context of rising interest rates. In terms of trying to remain patient, a week ago when the S&P 500 was testing the election gap, the XLP relative to SPY chart that we covered last week, chart dated January 10th, didn't seem to be screaming risk off. Right side of the screen really didn't look anything like this, and it really didn't look anything like Q4 of 2021 or Q1 of 2022. A similar situation this week. This is during the trading session on Friday, January 17th at 9:36 a.m. Eastern Time. Once again, defensive consumer staples underperforming SPY just as they did last week. This week, intraday on Friday, they were down 1.93% on a relative basis on the weekly chart. The right side of your screen here really doesn't look anything like the concerning setup that we had in late 2021 and early 2022 when the market is experiencing widespread concern about inflation, interest rates, and Fed policy, and as a consequence, concerns about growth. At least as of 11:36 a.m. Eastern Time on Friday, January 17th, our patience from last week and the last few weeks thus far has been rewarded. The S&P 500 up 3.08%, upper right-hand corner of your screen. I mean, even as of the close on Thursday, January 16th, when we look at the 50-day moving average in blue all the way out to the 200-day moving average in orange, really hadn't seen anything up here. The recent consolidation in this area here that said the current uptrend was in serious jeopardy of rolling over. If Thursday's chart, the upper right-hand portion of your screen, morphs into something more like this is Q1 of 2022, then concerns would increase. That may happen very, very soon, but a week ago, it hadn't happened yet, and as of the close on Thursday, January 16th, that was still the case. The same concepts on the weekly chart. You can see the 30-week moving average here in January of 2022. We get that hot knife through butter look. The weekly chart of the S&P 500 slashes through the 30-week, and it starts to flatten out and or roll over. It's not what we had as of the close on Thursday, January 16th. It looked like we were coming back to an upward sloping 30-week in blue. If this starts to morph into something more like this, then we would learn something about increasing bearish probabilities. So monthly cloud chart of the S&P 500, it can help us water test the secular trend thesis from a longer term perspective. The monthly chart here, you can see blue crosses below red, blue crosses below red. This is February of 2001 when we can see that, measure it, put it in a model. This is July of 2008 when we can see that, measure it, and put it in a model. That can be extraordinarily helpful because walking forward from this date and this date, things continued to get ugly over the next 588 calendar days. In this case, the S&P 500 lost an additional 37%. In this case, walking forward over the next 221 calendar days, the market lost an additional 46.62%. You can see, as of the close on January 16th, we don't have anything over here that looks like this or this. Ultimately, our job is to monitor the market's acceptance or lack thereof of risk. That's risk appetite. Are market participants slowly becoming more risk averse and defensive as they were here in 2021 and into January of 2022? Or are we within the context of a risk-on uptrend? And there are numerous ways to monitor the market's risk appetite, including using ARKF. When we show charts like this, it doesn't mean we're interested necessarily in buying ARKF, but it can be helpful in terms of managing risk and reward in the markets. In a nutshell, if you pause your video player, look at the moving averages with the 20-day in blue here in Q4 of 2021 on the bottom of the moving average stack. As of Thursday's close, the same moving average is on the top of the stack. If the look on the right side of your screen morphed into something like this, concerns would increase. That's not what we had as of Thursday's close, which aligns with a market that's more focused on future growth possibilities relative to concerns about inflation. If you know your market history, you know these periods: 1991, 1995, 2003, early 2013, early 2017, and after the COVID low in 2020. Those are good risk-on setups. Good things tended to happen walking forward from those periods. If we look at the NASDAQ Composite Tape Index as of the close on Wednesday, January 15th, this is a constructive setup. Has similar properties to this look in here, this look in here, and this look in here. Part of the weight of the evidence, and it leans risk on and or bullish. Again, if you know your market history, we look down here, good things happen in the S&P 500 in calendar year 2013 and 2014. If we look at the S&P 500 advanced decline volume line on a weekly chart, notice how the indicator tended to stay above the center line on the Bollinger Band during these risk-on periods. That's what we've been doing in 2024. And it looks like we're trying to make a stand early in 2025 in a similar and bullish region. If this starts to morph into something more like this, or something more like this, where the center line on the Bollinger Band rolls over, as the stock market's peaking in October of 2007, concerns would increase. That's just not what we have as of January 16, 2025. We just broke out of a long-term consolidation box, similar to this point here and this point here. Covered this chart numerous times. We really don't have anything in the credit markets that screams risk off, similar to this look during the COVID crash or similar to this rollover in 2022. And that aligns with credit spreads. Pulled this chart off of Fred on Thursday of this week. You can see credit spreads here really don't look anything like they did here during the dot-com bear market between March of 2000 and October of 2002. And this massive spike in credit fear here, economic fear, that started in 2007 and carried into 2008 during the financial crisis. And yes, you could say that credit spreads are about to flip. But we could have said that every single day since June of 2022. And had we done that, tried to predict when this may or may not spike, we would have missed a lot of upside. We're not using this chart to predict anything. If it starts to morph into something like this or something like this, then we learn something about increasing bearish probabilities and increasing probabilities relative to credit defaults and or an economic recession. As of the close on Thursday, this looks like normal consolidation above this point here in the NASDAQ. What once acted as resistance in July of 2024 may now act as support in November of 2024. We were still trading above both of those points as of the close on Thursday, and we're trading above this upward sloping trend line here where the market held in August of 2024. And if we extended that same line in a parallel manner, it would come in here in this region here somewhere. Moral of the story here, a lot of potential support in this area here below price, all the consolidation occurring above those levels. You can see similar concepts if you pause your video player on the weekly chart of the NASDAQ Composite. And as of the close on Thursday, January 16th, the weekly cloud really didn't look anything like this concerning rollover look here in January of 2022. You can see when price plummets here in the first few trading days of 2022, the lagging span here, the green span, slashes below price. That tells you you've got a weakening trend here. Same is true with blue crossing below red. Look at the bullet points up here. Look where we are today when we come back here. Look where the green lagging span is. It's really nowhere near price. It's not what we had back here. This is a weak, vulnerable look. This is still a strong trend look. If this morphs into something more like this, we'll learn something. We don't see anything yet that says the NASDAQ is giving up its leadership relative to the NYSE composite. This is the NYSE composite as of the close on Thursday, January 16th. It's a weekly chart. You can see the ratio is below a downward sloping 200-week moving average. In red, the last thing the ratio did was make a new lower low. NYSE advanced decline volume monthly with the 50-month moving average. We get a cross here in 2003. That's a bullish period for the market. Cross here in 2009 after the major low in March of 2009. Cross here after the S&P 500 bottoms in February of 2016. We had something similar in 2024. It was helpful then. It still looks constructive. If this morphs into something more like this, or this, or this, concerns would increase. A lot of potential support down here as of the close on Thursday in the Dow Jones Composite. Covers all sectors. You can see the breakdown here. All of this consolidation occurring above this long-term consolidation box, which means this is an area of strong potential support. All of this occurring above an upward sloping 250-day moving average in silver. Midcaps in isolation making a stand near a logical region, near that upward sloping 30-week moving average in blue. This is as of the close on Thursday, January 16th. All of this consolidation here also occurring above a long-term consolidation box, meaning this is an area down here of strong potential support. Midcaps still look good in isolation, but they're still underperforming in terms of their trend relative to the S&P 500. This is the same 30, 40, and 50-week moving averages, also as of the close on Thursday, but this time it's the S&P 400 midcap relative to the S&P 500. If this morphs into something more like this, that would be good for midcaps. May happen very, very soon. Hasn't happened yet. Everything that we just said about the chart of midcaps relative to the S&P 500 applies to the chart of small caps. We have broken this trend line. So if this ratio can get out here, that would be a good first step relative to small caps trying to take a leadership role. Right now, the last thing this ratio did was make a significant multi-month new low late in 2024. We do have some sideways action in here, so we have to keep an open mind about something like this potentially occurring. But notice what happens here. The 50-day moving average shoots up like a rocket through the 200-day, and then the 200-day flattens out and turns up. We don't really have anything like that yet. This is more of a tepid look. But just as this look changed quickly here, something similar could happen again. So we don't want to keep a closed mind about small caps. NASDAQ 100 also came down and tested the election gap here and thus far has held. This is as of Thursday's close. A nice looking weekly chart in isolation of the NASDAQ 100, similar to the triple Qs in the ETF world. We have a full bore bullish look with price above all the moving averages, blue the fastest moving average on top, and green the slowest moving average on the bottom of the stack. RSI has also been holding above 50, indicative of an uptrend. Same concepts apply here to the monthly cloud. Typically when blue crosses above red and we get the full bore bullish look, That's during bull markets, similar to this point here in 2009, similar to this look in 2004, and this recent bullish setup and improvement really doesn't look anything like January of 2001 or September of 2008. As of Thursday's close, the S&P 1500 composite index, this looks like normal consolidation coming back to the upward sloping trend. We'd learn something if price moves into this area here and undercuts this high from July of last year. What once acted as resistance, thus far is acting as support. Nothing as of a close on Thursday, January 16th over here that looks like this concerning rollover look that we had in calendar year 2022. To the contrary, this is a strong uptrend look in January of 2025. And as we've mentioned in videos in recent years, if this chart looks this good in isolation, and this week on a relative basis, this is the same S&P Composite 1500 relative to the S&P 500, the ratio is below a downward sloping 200-day moving average in blue. If this looks this good, that's good for the S&P 500. Similar to the small cap chart, see all this consolidation in here before this run up in the equal weight. Don't have a lot here other than consolidation. So if this ratio moves into this area here, similar to this look here, then it's possible we could get to a point where RSP, the equal weight S&P 500, starts to outperform. But we just don't have enough yet. But there's enough here to pay attention with an open mind, and we'll continue to do that. But this really doesn't look anything like this in January of 2022. And we don't have anything on this monthly chart dating all the way back to 1952 here that says the secular trend, a demographically driven secular bull market in stocks. There's nothing on this chart here that puts that thesis in serious doubt. We have to keep in mind, even in the context of a secular trend, markets are going to have 100% normal and to be expected drawdowns. If we look at the drawdowns greater than 6% in the context of secular trend windows, average drawdown about 12%, median around 10%. If we look at all of them, meaning if we look at the maximum annual drawdown between 1950 and 1968 and 1982 to 1999, those are secular bull markets, very similar numbers. And as you would imagine, they're a little lower. The average intra-year drawdown, about 11%. The median intra-year drawdown, about 9%. What does that tell us? It tells us if you're going to try to capture the gains during a long-term trend, it's probably not in your best interest to do a lot in terms of getting defensive when the market falls between 0 and 10 or 12%, because that's 100% normal and to be expected. And within the context of a secular trend, eventually, by definition, you go on to make a higher high. And that's where mitigation 1 and mitigation 2 come into play. When your drawdown gets into the 8 to 12% region, we can't assume that we're not morphing into something more like this, or this. And if the secular trend starts to roll over, that's where mitigation 2 comes in an instance similar to this, or this, where the S&P 500 in both cases lost approximately 50% of its value. Right now, upper right-hand corner of the screen, Thursday, January 16th, everything looks good, and that aligns with the model scores that we've been covering in these videos for several months. You can find this on our X feed. Here's our Twitter handle here. There's nothing on the chart, which is described here, that says this growth breakout is in serious jeopardy in any way, and that's been true during the recent pullback. And we don't want to get overly wound up about relative charts. IWF and IWD both look good in isolation. So our goal is to try to stay with the secular trend. We don't want to get too fearful about normal drawdowns. But if a normal drawdown starts to morph into something like the dot-com bust or the financial crisis, we all know the only way that we're going to be able to handle that effectively and use all of this effectively is if we had it in next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.